You're told it started on June 28, 1914, the day an Austrian archduke got shot in Sarajevo. That's the official story. But it's wrong. That's like saying the Titanic sank because it hit ice. Sure, that's what happened on the surface. But it's the what, not the why. What if the real cause was a financial crisis? That had already bankrupted Europe's great powers decades before anyone fired a shot? The assassination wasn't the cause, it was the excuse. It was the trigger they needed to solve a financial problem that threatened to destroy their empires. This wasn't a war for glory or land or ideology. This was the world's most expensive and most bloody debt consolidation program. To understand how debt rules our world, we have to go back. The story begins in the 1850s. European powers discovered a new, terrifyingly powerful weapon, sovereign debt. They realized you could borrow money to build an empire, then you could earn it through conquest or trade. Britain led the charge. It used massive loans to fund railways across India, to build naval bases on 6 different continents, to maintain the largest military force the world had ever seen. The system worked brilliantly for a while, but here's where the math gets dangerous. By 1914, Britain's national debt had ballooned to pounds $650 million. That's an astronomical pounds $77 billion in 2024 money. It was a monster that required careful management and constant refinancing year after year. France, Germany, and Russia followed the exact same playbook. Each borrowed heavily to fund its own imperial ambitions. They thought they were playing a game of territorial expansion. They were actually playing a game of compound interest. And the interest always comes due. Think about your own mortgage for a moment. You probably calculated your monthly payments carefully. You made sure you could handle the interest rate. But now, imagine if your neighbor was also buying houses, and your other neighbor was buying even bigger houses. And suddenly you felt pressure to buy more and more houses just to keep up. You're not buying them to live in. You're buying them so your neighbors don't get them first. That's precisely what happened to Europe's great powers. Except instead of houses, they were buying battleships, armies, and entire continents. And they were funding it all with debt. Germany provides the most dramatic example of this imperial debt spiral. Kaiser Wilhelm II was desperate for Germany to have its place in the sun. He wanted to challenge British naval supremacy on the high seas. German borrowing exploded. It funded a new high seas fleet to rival the Royal Navy. It funded railways across German East Africa. It funded new colonies in the Pacific. The German government convinced itself and its bankers that each new territorial acquisition would pay for itself. They believed rising asset values from resource extraction and new trade would always cover the rising debt payments. Does that sound familiar? It's the exact same logic that fueled our housing bubble in 2008. And just like in 2008, the world got a preview of what happens when this debt bubble bursts. The preview came from the sick man of Europe, the Ottoman Empire. In 1875, the Ottoman government in Constantinople declared bankruptcy. It had debts totaling pounds $200 million. Here's the kicker. Their annual debt payments exceeded half of their entire national revenue. The empire was financially broken. The European creditors in London and Paris didn't just write off the loss. They staged a financial takeover. They established the Ottoman Public Debt Administration. This was a committee of foreign bondholders, given direct control over the Ottoman economy. They seized control of Turkish tax collection. They controlled government spending. Think about that for a second. A sovereign nation controlling territory across 3 continents ... essentially became a subsidiary of European banks. The Ottoman sultans could still wear their ceremonial robes. But the real financial decisions were being made in London and Paris. This wasn't just debt restructuring. This was the template for modern financial colonialism. And every other empire in Europe was watching. They all knew, if we fail, this is our fate. This brings us to the Declaration of London in 1909, later ratified. It made this dangerous game official. It formally recognized credit as an essential element of the Anglo-French-Russian alliance. Military partnerships were now explicitly tied to financial partnerships. When you signed up as an ally, you weren't just agreeing to fight together. You were agreeing to borrow together. You were guaranteeing each other's debts and sharing the financial risks of imperial competition. By 1914, every major European power was trapped in the same impossible situation. They owed massive, unpayable debts. These debts required constant territorial expansion just to service the interest. But territorial expansion required even more borrowing to fund the armies and navies. It was a spiral. The system had become mathematically unstable. Something had to give. Either these empires would find a way to dramatically increase their revenues, or they would face a total financial collapse, just like the Ottomans. War, it turned out, offered both a solution and an excuse. Military victory would mean access to enemy territories and resources, solving the revenue problem. You could seize your enemy's assets to pay your bills. And a military necessity would justify levels of government borrowing that would be politically impossible during peacetime. The assassination in Sarajevo didn't cause the crisis. It unlocked the solution. Here's where the story gets really interesting. Because by 1916, 2 years into the war, something unprecedented was happening in global finance. Britain wasn't just funding its own war. It was funding everyone. It was paying for all of Italy's war costs. It was paying for 2/3 of what France and Russia were spending on their military operations. Think about that. One country was essentially the central banker for a world war involving dozens of nations. How does that even work financially? The answer lies in a web of international banking relationships that determined the fate of millions. And it all leads to one office on Wall Street. We need to ask a question that should grab our attention. Why was J.P. Morgan Jr., an American banker, organizing military supply contracts for European armies, 2 years before America even entered the war? In 1915, Morgan put together a syndicate of 2,200 American banks. They floated a $500 million loan to the Allied powers. That's $14 billion in today's money. But here is the kicker. This wasn't just a loan. The contract stipulated that every single British munitions purchase had to go through Morgan firms. Morgan's bankers were given direct control over European military procurement. Pop quiz. When a foreign bank controls your military supply chain, are you still a sovereign nation? Or have you become something else entirely? Britain, the empire that ruled a quarter of the world's landmass, had effectively outsourced its war finance to Wall Street. The lion was borrowing money from the eagle to buy its bullets. The really wild part is what happened to interest rates. As European governments borrowed more and more money, the cost of borrowing kept climbing. Higher interest rates meant that territorial expansion wasn't just politically desirable. It was mathematically necessary. You needed new revenue streams just to service your existing debt, let alone fund new campaigns. France and Russia found themselves in an especially dangerous position. Their massive gold reserves became crucial leverage in alliance negotiations. They weren't just promising to fight together. They were promising to share the financial burden of keeping each other's government solvent. Meanwhile, in Germany, the Reichsbank was providing short-term credit to the government, while war loans consolidated the long-term debt. Financial historians now recognize this as an early version of debt monetization. The German government was essentially printing money, to pay interest on money it had already borrowed, to fund military operations that were supposed to generate enough plunder, to pay back the original loans. Does this sound familiar? It's the same cycle that led to our 2008 financial crisis, except instead of mortgage-backed securities, European powers were betting on victory-backed securities. Each new military campaign was supposed to pay for itself through territorial conquest and reparation payments. The entire continent was leveraged to the hilt. And who held this debt? The Bank of England, Rothschilds, Barings, Morgans, Kleinworths, Schroders, London's great merchant banks, dominated international investment. They had enormous financial stakes in the outcome. These weren't neutral observers providing banking services. They were active participants whose bond portfolios depended on specific military outcomes. Let me put this in perspective with a modern example. Imagine if Goldman Sachs, J.P. Morgan Chase, and Bank of America had each loaned billions of dollars to different sides in a regional conflict, and the loan terms depended on who won. Now imagine that these banks also controlled the weapons suppliers for each side. Do you think those banks would remain neutral, or would they have strong incentives to influence the outcome? That's exactly what happened in Europe. International lending had created mutual dependencies. When Britain loaned money to France and Russia, British banks weren't just hoping for repayment. They were betting on an Allied victory. When German banks financed Austrian military operations, they were making the same bet. The result was a financial system where military defeat meant total economic collapse. Losing the war meant defaulting on international loans. It meant losing access to global credit markets. It meant facing the exact same foreign financial control that had happened to the Ottoman Empire. By 1916, the war had become a massive game of musical chairs. Whoever stopped fighting first would face complete economic devastation. This is why the conflict escalated so quickly and became so brutally total. It wasn't enough to win a few battles. Each side needed complete victory to generate enough plunder and reparations to pay back their international creditors. Anything less than total victory meant financial ruin. Now we get to the part of the story that completely changes how you understand America's role. You've probably heard that the United States tried to stay neutral. That's the official version. The real version involves J.P. Morgan Jr. and the largest financial gamble in human history. Picture Morgan in his Wall Street office in 1917. By this point, his private firms had organized loans totaling $1.5 billion to the Allied powers. That's roughly $35 billion in today's money. But Morgan was just the beginning. The situation had escalated far beyond private banking. The United States Treasury itself was extending massive loans directly to European governments. America would lend more than $10 billion to foreign nations. This one move transformed the global financial system overnight. The United States went from being a net international debtor of $3.2 billion in 1914 to becoming the world's largest creditor nation by 1918. Here's where the timing gets suspicious. The Federal Reserve, America's central banking system, was created in December 1930, just 8 months before the war started. Coincidence? The Fed provided the institutional framework that made this massive war debt monetization possible. Without the Federal Reserve's new ability to expand the money supply and coordinate with private banks, the scale of American lending to Europe would have been financially impossible. Let's talk about what this meant in practical terms. American entry into the war in 1917 wasn't just about submarines or diplomatic tensions. By 1917, American banks and the U.S. government had loaned so much money to the Allied powers that an Allied defeat would have triggered the largest financial crisis in American history. Morgan and his associates weren't just hoping for Allied victory. They desperately needed it to avoid bankruptcy. Think about this scenario. You've loaned your life savings to a friend who's in a fight. If your friend loses the fight, you never see your money again. If your friend wins, you get your money back with interest. Are you going to stay neutral in that fight? Or are you going to do everything possible to help your friend win? That's exactly the position America found itself in by 1917. In just 3 years, the United States went from neutral observer to active participant. Not because of political ideology, but because of financial exposure. American doughboys shipped to European battlefields weren't just fighting for freedom. They were fighting to collect on debts that European powers owed to American banks. And here's the part that should really grab our attention. While European powers were bleeding themselves to death in trenches, American industrial capacity was exploding. Massive Allied purchases of American weapons, food, and raw materials reversed our international debt position. and established the foundation for American economic dominance for the next 100 years. Morgan and his associates had figured out how to profit from European self-destruction. They weren't funding a war. They were funding the transfer of global economic power ... from European empires to American financial institutions. Every artillery shell fired in France. Every tank rolling across Belgian fields. Every battleship sunk in the Atlantic ... represented loan payments flowing from European treasuries to American banks. The human drama here is staggering. Young men from British farms and German villages were killing each other ... to determine whether Morgan's loans would be repaid ... or whether they would default entirely. By the time America officially entered the war, our participation was inevitable. We weren't choosing sides based on democratic values. We were protecting a financial investment that had grown too large to fail. Now we reach the moment when the entire financial house of cards becomes visible. What happened after the armistice wasn't peace. It was the largest debt restructuring operation in human history ... disguised as treaty negotiations. Here's the shocking reality. In 1914, the United Kingdom's national debt was £650 million. By the war's end in 1919, it had exploded to $7.4 billion. That's a more than 1,000% increase. France, Russia, and Germany faced similar debt explosions that made normal peacetime governance financially impossible. These weren't just big numbers. They represented obligations that would consume national budgets for generations. But the real revelation comes when you follow the money flow after the Treaty of Versailles. Germany was required to pay massive reparations to Britain and France. But here's the twist: Germany was broke. So it financed those reparation payments with new loans from American banks. Britain and France then used that German reparation money ... to the United States. It was a perfect circular debt arrangement. American banks were essentially lending Germany money ... to pay reparations ... that would flow right back to American creditors. Let's look at the numbers. Between 1919 and 1932, Germany paid 19 billion gold marks in reparations. During that same period, Germany received 27 billion gold marks in loans from American banks. Germany was borrowing more money than it was paying out. The Treaty of Versailles wasn't really a peace agreement. It was a debt collection mechanism. It established American financial institutions as the ultimate arbiters of European economic policy. This created a fundamental mismatch in expectations. European powers like Britain and France expected debt forgiveness. They had borrowed assuming they were defending civilization. They argued for shared sacrifice, but they discovered that Americans treated international lending as a business investment, an investment aimed at maximizing profit, not supporting allies. American creditors expected full repayment with interest based on commercial terms. When those expectations collided, the result was economic policies that prioritized debt service over human welfare. The scale of this financial control becomes clear when you look at how long these obligations lasted. The final installment of German World War I debt ... was unpaid until October 3, 2010. Read that again. 2010 Germany spent 92 years paying for a war that lasted 4 years. British war debt payments to the United States continued until 2006. France didn't finish paying its World War I obligations until 2009. This means that people who were born decades after the armistice ... spent their entire working lives paying taxes to service debts incurred by governments that had ceased to exist before their grandparents were born. The war had ended. But the financial obligations created a permanent system of international wealth transfer. While ordinary Europeans spent the next century paying for this arrangement, the banking institutions that created the debt spiral became more powerful and profitable than ever. World War I established the template for modern sovereign debt crises. It proved that military conflicts serve as opportunities for financial institutions ... to establish permanent revenue streams through government indebtedness. The pattern repeats throughout the 20th century. International conflicts create emergency borrowing situations. Emergency borrowing allows financial institutions to establish long-term control over national economic policies. Debt service requirements then shape domestic priorities for generations. Regardless of democratic preferences or changing political leadership. When you understand this system, current events start to make more sense. Why do sovereign debt crises always seem to result in austerity policies that benefit international creditors? Why do military conflicts consistently lead to increased government indebtedness? Why do peace negotiations always involve complex financial arrangements that seem to matter more than political agreements? The answer is that World War I established a precedent where international conflicts served primarily as debt consolidation exercises. The war to end all wars didn't end war. It made war financially profitable on a permanent basis. The bankers won World War I, and we are all still living in the world they built. We're all still paying for their victory. So, is our modern system of global debt, where nations are locked in a financial embrace, a force for peace? Or is it the 1914 model, just waiting for a single trigger to pull the whole thing down? Let me know your prediction in the comments. And subscribe, because we're going to follow this money right into the 21st century.